Welcome, guys. Good morning. Welcome to Purvis Trade, another video. On this one, I wanted to get back into trading. I want to focus on some more trading concepts, and mainly I want to talk about intraday trading, or basically finishing, opening, and closing a trade within the same day is what we're talking about when we talk about intraday trading. I'll give you guys some strategies, what I think about intraday trading, what my experience has been regarding it, and if I recommend it or not. So yeah, let's get started. First thing first, you guys have to understand about intraday trading, which is that it is a method which, yeah. So as I was saying, the first thing you guys have to understand about intraday trading is that it's extremely sensitive to news. Okay, when you're talking about intraday trading, you're talking about price movements within the same day that you're trying to take advantage of. And that price movements within the same day usually come from the latest news. Okay. And look, I'm going to give you intraday trading strategies, but I'll tell you first what my experience has been. Okay. So, what I've experienced is that, yes, there will be price movements in the stocks, in the commodities, whatever product you're trading based on the latest news that's out there, right? If you have a CPI data on a currency, that currency will move in a specific way usually if the CPI data, inflation data, jobs number data are vastly different from forecast. Same with the stock. If earnings report is coming out and there's a forecast, the actual earnings is vastly different than the forecast. There will be significant price fluctuation. This is what people have to understand. You don't just need a news on the product that you're trading. You need a news that's vastly different from what the market has been expecting. That's where you can make good money in intraday trading. Okay. So if you're trading a stock, it has an earnings report coming out today, maybe midday, maybe morning before trading starts or just after trading starts within the trading day. And the actual earnings report comes similar to the forecast, you're not going to make a lot of money. There's not going to be significant price fluctuation for you to make money unless you use leverage. But I talked about leverage, why it's not recommended, because you can lose your entire capital equity if the position moves against you and you don't close it fast enough. And more often than not, small fluctuations will close out your entire position, even if you're right. So you have a price, you're expecting the price to go up, but a small dip before the price goes up, that small dip, because you have a 500x leverage, will mean your position is closed out before you can take advantage of the price going up. So leverage is not recommended. Intraday trading, um, leverage is not recommended in general. Okay, in intraday trading, if you're trying to make money, you have to find financial products, stocks, commodities, whatever it is, currencies, forex market, where there's a news, and the news is vastly different to the forecast, to the market sentiment. So you don't just need news on the product that you're trading. You need a news that's vastly different to what people are expecting. But what my experience has been is that, look, there's a lot of laws against insider trading, but let's not kid ourselves. It's very hard to regulate insider trading. Okay? If you have worked for a big company, publicly traded company, you know very well there are people in the organization that will get those earnings report data before it's published to the rest of the world. Okay. And there's many ways to cover your tracks and do insider trading. So what happens usually is when the insiders get the earnings report and before it's published, and if the earnings report is vastly different to what the forecast has been from the market, they're gonna start putting the positions in before the earnings report comes out. If you're trading a stock, for example. And once the earnings report comes out and it's vastly different than the forecast, market reacts. But I'll give you a simple example. Let's say there's a stock A. The earnings is expected to be $1 per share. That's the forecast. And the earnings report is expected to come out at 10 a.m. And 8 a.m. in the morning before the market opens, let's say 7:30, 8 a.m., the people, insiders in the office, got their hands on the earnings report and they saw that the actual earnings per share that's going to be published is 80 cents per share. So significantly below forecast. Before the market opens, they're going to start dumping their shares. Very simple. So when the market opens, you'll see a lot of dumping of shares, price falling down. And they'll get people, other people who use the insider information, like hedge funds, they'll relay the information so that they'll also start dumping their shares. And by the time the actual news comes out at 10 a.m. that the earnings is vastly lower than forecast, the actual players have already dumped their shares, right? So when the actual report comes out at 10 a.m., sure, the market will start dumping their shares. But what usually happens is the big players, the big institutional holders of the stock, already closed their positions using insider information. And this happens more often than you think, more frequently than you think. And yeah, so what does that mean? It means that even in insider, like intraday trading, and you're trying to trade on latest news report that's vastly different than forecast or market sentiment. There are people more often than not that already has the data and that have relayed that information to the big traders, the hedge funds, and they've already closed their positions before the actual news comes out. And you're not gonna be able to make much difference. You know what I've seen? I'll give a pretty good example. Like for example, like the stock A I was talking about. I've seen that example where the insiders, the big institutional holders, they dump their shares before the earnings report comes out at 10 a.m. in this case. And then at 10 a.m., the other market players really react to the news and start dumping their shares. So the price then start going down. So the prices have been falling since 8 a.m. But then at 10 a.m., it also starts falling as the other market players react. But then it picks up again. Why? It's because the institutional investors, the insiders start buying. Because even though they saw lower earnings per share, they probably not, you know what I mean? Like, unless the forecast of the company is bad overall in the future, they'll just buy back the share at a low price. Uh, so I've seen that happen. And if you guys don't understand what I'm talking about, you have insiders, big money players, institutional holders. They're dumping their shares from 8 a.m. because they got inside news that the earnings report at 10 a.m. is going to be far below the forecast. At 10 a.m., by that 10 a.m., prices have fallen significantly. The big players have already dumped their stock. And at 10 a.m., the report comes out. The other market players starts reacting, starts dumping their shares. And by this period, what usually happens is the price has reached a bottom. It's been oversold in RSI terms, and it's usually reached a resistance level. And that's when the big money players come in and buy up the stock. Because, you know, more often than not, it's just a company having a bad quarter. Unless the future looks bad for the company, that's a different case. But usually it's a company having a bad quarter, but the future looks bright. So they sell at high price, buy it back at low price, and they make money on the trade that way. And this happens more often than you think. So you have to understand intraday trading, if you're trying to make significant amount of gains in intraday trading, it's extremely news sensitive. And the news has to be vastly different than forecast. And somehow that news has to be not manipulated or subject or exposed to insiders trading. So, and that happens too. Like, there could be a war launched, and those kind of data, those kind of intel, usually most people, even insiders of companies, don't get, right? It's a war or a cyclone or a natural disaster, stuff like that. Stuff you can't get insider information on. In those situations, sure, all the market players, including the big money players, are reacting at the same time. And then, yeah, you can make money because now there's a sudden news that's not expected. Sure. But the main idea remains is that it's extremely sensitive to the news, and the news has to be vastly different to what the market sentiment is. So that's one thing you guys have to understand about intraday trading. It's not as simple as most people think. A lot of people think, oh, I'll trade this forex currency pair, this CPI data, or this inflation data, or this jobless claim data will come out on USA, or for example, Canada. And this is the forecast. Whatever comes out below or above forecast, I'll trade or that on that news and I'll make money. No, you're not. Like what? You're not gonna make money because you have to understand there's so much trades that's been happening around the big news item like a CPI data release or jobless data claim, stuff like that. If you're trading a forex pair on related to that stat, there's a lot of volumes of trades going on, and by the time your trade is executed, the market has already priced in. And it happens so fast, especially in the world we live in right now. The markets move very fast. So by the time your trade has been executed, especially if you're trading around those high volume, uh, critical news events, your trade is going to take a while to execute. And by the time the market has priced in most of the news item. And like I said, insiders usually price in before that because they have inside news, even related to Forex stuff, jobless claim, CPA data. You think those things just release at the exact moment they said that, like people inside the government have access to those data before it's released to the public. So they will sell their intel to the big money players who will close their positions before the actual news report comes out. So the market has more or less priced in the market shock, the news shock. And so by the time the actual news comes out, there's very little gain to make. And yeah, that's been my experience. In terms of how you can still make money in intraday trading, obviously people talk about trading with statistical analysis, right? Having chart patterns, Bollinger Bands, RSI, and all that. I mean, sure, you can use chart pattern analysis to do trading, but in my experience, all your chart patterns can indicate you to a trade up or down a certain way. Then a sudden news will break out and the chart patterns will all collapse over your head. That happens more often than you think. All your chart patterns are telling you to go long on this stock or whatever. And then there's a sudden news on the stock. And this happens more frequently than you think. And all of a sudden the stock is falling in price. And it happens. It happens, okay? So what's the best thing to do? Look, from what I've experienced, if you trade people who do intraday trading, they buy in the morning and sell by the end of the day. And very few people wait until the end of the day. Most people buy early in the morning and sell around noon, midday. So yeah, what does that mean? Well, that means that you're gonna have a lot of selling pressure post midday and a lot of buying pressure in the morning. That's what it means. So yeah, and so how do you make money on that? Right? That's a very simple thing to think about. you can do short, but then you also need margin because short is basically borrowing a stock to sell it and then buying it back. So you need margin, you need collateral, right? Because short has unlimited downside, unlike a put option, like a long option, which has 100% downside, not unlimited. And yeah, so in my experience, intraday trading is not ideal because of the factors I just mentioned. It's extremely news sensitive. Your chart pattern analysis, all of that will fall over your head the moment there's a news that goes against all your chart pattern analysis. And the best thing you can do if you still want to do intraday trading is look for liquidity, high volume stock. And so this is what I used to do. When the market opens, I'll go to the website. Let's say I'm trading in, let's say, New York Stock Exchange. I'll go to the website. I'll see the highest, which stocks that have the highest volume of trade. These stocks have the most liquidity. And the reason I'm looking for the most liquid stocks is because they're likely to have the lowest spread. So the lowest spread allows me to buy and sell with the minimum lowest transaction cost. Are you guys with me? High liquidity usually tends to have low spreads. Low spreads means the difference between the buy and sell price. Low buy and sell price difference means I can buy and sell. If I buy it and I think it's going against my wish, I can sell it and face a very low loss, minimum loss, because the buy and sell price is low. So I look for stocks that have high volume, high liquidity, so I can get in, get out fast, without large transaction cost, as they call it in the market. And yeah, I highly recommend not to trade around news sensitive event period because, like I said, there are people out there who will have access to that news item before it's released to the public, and they'll probably have already priced in that into the market by closing their big positions, and they're probably looking to make more money by buying up or by doing the opposite when the actual news item comes out and other market players panic, like I explained. So it's an uphill battle you're fighting. So yeah, like I don't recommend intraday trading to be honest. I think you should focus more on fundamentals. Like I said, I mentioned in the previous video, another video, cash flow, book value, market share, stuff like this, fundamentals. Focus on the fundamentals. Intraday trading you're gonna lose money in the long run. That's my prediction. Using leverage is not gonna work because of the reason I mentioned. Small dip in price, change in price in the opposite direction to your trade will usually close out your position and lose more money than you actually invested in the trade. And yeah, so I don't believe in that. And so what I do say is that if you're going to do it, focus on high volume financial instruments, high liquidity, and focus on instruments with the highest price change. So whenever the market opens, you can go to the website of the financial stock exchange or whatever it is and see which financial instruments are having the most price decrease, price increase, and also the financial instruments which are having the largest volume of trades early morning. Because early morning, the financial instruments that are having the largest volume of trades and the largest price fluctuation are usually the products that are going to be traded heavily throughout the day. And if you can understand the trend, you can probably make some money. But like I said, it's an uphill battle, especially if there's a news event coming up. You're fighting an uphill battle. So I highly don't recommend doing that. But yeah, I want to just make a video on this. People have been asking me about intraday trading, what my op opinions are on it. I'm on the no side, but if you're gonna do it, follow the basics, large volume trade, large price fluctuations, early morning. Those are the products that are gonna be traded throughout the day, and that's where you're most likely to make money. So yeah, that's it for this one. I'll come back with another video pretty soon. Until then, peace.